Welcome to the Gray Report. Is the real estate market in more trouble than it's letting on? Well, while there's trouble down in the Sun Belt and the Midwest seems relatively stable, there are still some warning signs that we want to take a little bit of a closer look at. But at the same time, there's some real bright spots, and it seems like the weather is clearing and there's light at the end of the tunnel. But have we gone through enough pain, really, to be into the promised land? Not so sure. That's what we want to talk about today. So I want to make sure you stick around for the entire episode. Subscribe to the Great Capital YouTube channel for more, and let's get into it. Welcome back to the Gray Report. Joined again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Great Capital. It's been a good week so far for you, Matt?
Pretty good week. It's been really interesting. Yeah.
Good. Well, okay, there's a piece from Real Page. Concession values are up, but number of units offering discounts has faded. This is on this topic, Matt, of is the housing market on fire or is it not? I could be convinced either way. There's an article that'll come out about, huge inventories, down in Florida and Texas and price declines. But then also I hear about really tight markets in other regions. Obviously, the entire United States, the whole country, it's hard to kind of paint with a broad brush. So we want to get into kind of where are we? Where is the whole market going? Is the good news going to outweigh the bad and kind of lift the whole market up? Or is there so much negativity and just structural problems that are just going to tear the whole thing down? So one piece of this and one sign either way is concessions. Yeah. Talking about the multifamily market, concession is we're going to give you a little bit of a discount. Whether it's $100 off a month, or we're going to give you a gift card, but some kind of monetary incentive to get you to lease the apartment. A ton of concessions have been going on because we've just delivered a record amount of new apartments. And we got to get those apartments leased up because at the same time, these developers, their interest carry, the amount that they're spending on interest payments on their loan, floating rate loans, it's double, triple what they underwrote. And it's taking longer to lease up. So they're having to go in their own pockets and pay this interest carry because it's going way over what they thought. So they're willing to pay for residents, for people to move into their apartments so they can be stabilized, so they can put in permanent fixed rate debt, or sell the thing. And so they're offering concessions. And so this Real Page analytics blog, authored by Kim O'Brien, is getting into the nuance of, look, we're giving out some really high ticket concessions, but the number of concessions are going down. Have I got that right?
Yeah. So I think that essentially it's probably concentrated among newly built apartments. That's what the implication is.
I don't know.
Because it says, while this is some of the this is just a quote from the article, while this is some of the highest level of concession usage the U.S. has seen in stabilized assets in the last decade or so, there's a key difference in today's concessions versus the similarly high levels of concessions usage during the Great Financial Crisis in 2008 and 2009. That difference the difference is that what is driving concessions is not a lack of demand, but rather an intense barrage of supply. I think that we're still in this intense barrage
because
of supply.
Demand has never been, we're seeing record demand.
Yeah.
Right now, today, and we're getting past this wave of record supply.
Yeah, I'd be curious to see the concession rate among because my thought is, there's a lot of newly built apartments. You build this new apartment and you offer those concessions in order to get it filled up. And in a market where there's a lot of new apartments and a lot of them are being built, well, naturally this is just a temporary phase, and I'm not sure how it would trickle down, but I think that was where my brain went when I was reading the article was, there's a lot of newly built, they're all filling up, and that's driving the value of concessions. And then the thought of the number of concessions going down, that may mean that, the market as a whole isn't offering concessions. It's just these newly built ones. I don't know. I'd have to see how it gets sliced and diced.
I think there may be something there. I think you may be onto something. Now, I do think that there is a component that is similar to what we've seen in B class and C class apartment communities relative to Class A, of where, rents on some of those newly constructed Class A stuff have gone down slightly because there's so much supply, has affected the rents of Class B and Class C. I think there's also some crossover of a lot of times it's like a race to the bottom, and the competition across the street is offering a concession. Therefore, we have to offer one too. Because what happens in these asset management meetings is people get around a table and they're like, why are we 90% occupied pre-leased to 80, 88? That's not, we're missing our metrics. What can we do to turn this around and get some more leases? Yeah. And you look at your market comps, be like, well, are our rents too high? Where are we relative to the market? And so you do a comparative analysis, and you're looking at, your property, and you're looking at all the competitive properties, in the area that, prospects and residents say that they're taking a look at also. And you're comparing how occupied are they? What are they charging in rent? For the different floor plans relative to yours. And then what concessions are they offering?
Now, I have a question. Is there some psychology about offering a concession versus offering lower rent? Is there budget? Is there like budget and asset management things where we like to see it here and not here?
Oh yes. Yeah. There's so much strategy. Yeah. I mean, for example, and it can get tricky too. So, and some owners and operators can play some accounting games. Yeah. I think it's fine, depending on how you look at it, depending on what their goals are. Yeah. For example, a developer, they might, I've seen where they'll have certain promotions. Instead of like giving $100 off per month, which is like on your lease, you're going to give some sort of like incentive, some sort of like bonus, like a one-time concession. Yeah. So what was big in COVID and is still around today is like $1,000 gift card. Like dang, $1,000 seems like a lot. Yeah. It's less than $100 off per month though.
Yeah, and it stays off the books somehow.
It stays off the books. Yeah. Some people might even put it on their marketing budget. Yeah. Instead, so it doesn't affect their rent roll at all. It just affects that marketing line item. And especially if you're talking, let's say you're going to sell it, or you're going to refinance, and you're talking to a lender, or you're talking to a broker about the financials, you could have the an easy explanation of say, hey, look, these are one-time concessions. They're not going to affect the renewal rate. The resident doesn't look at it as like, oh, you're increasing my rent by $100 because they're still paying that rate. Yeah. It's easy to tell that next seller, that buyer, to be like, yeah, you can just phase that out. It's not affecting the rent roll. That's
interesting. It's like an implied rent boost, kind of, if you're putting the money in the gift card rather than in the rents. So in that way, you like the renewal's like, oh yeah, this is your rent.
Just think of it as like the rent being a little stickier. Yeah, like what's in the lease, what's in the rent roll is stickier. Like a lender's going to look at that as a harder number than a marketing line item, which seems much more elective and controllable, and we can just turn that off. We can just stop giving the gifts, the gift cards or whatever you're doing. So there's some strategy.
I mean, there is a benefit too of if you're from a renter. I'd rather have the money now than the money spread out probably over. Rather have $1,000 now than $100 every month.
Go spend $1,000 now. So that's definitely a strategy. But there will also be just lowering the rent for like a limited time. What it creates is a race to the bottom. And again, talking about if your competition across the street is doing it, and you're not performing really well, you will likely consider doing it as well, because you're saying, what's the difference between them and us? Yeah. If the only difference is they're offering a special, it's like, well, we got to offer the special and see what happens. And then your next competitor down the road, who may be a little bit, who's, maybe it's even like on the fringes, and that's where it permeates through the different asset classes, is because obviously, there's the B plus. The B plus has some overlap with the A minus or the A, and so on.
You can offer that concession to maybe convince someone. Yeah.
Well, it can just cascade down through the asset classes. And going back to your hypothesis, though, of why we're seeing higher value concessions are up, but the number of units being offered, easily could be that, it's more targeted towards newer A-class product, and they're doing these larger upfront concessions to get people to
that
move
mine
in.
is a little more mechanical than kind of an organic spread through the market, but I'm sure a little bit of both's happening in the way that you explain it, for sure.
But what is interesting, and there's another couple pieces that we're going to talk about, great financial crisis versus compared to today, is that how quickly the run up in supply was, and how fast and aggressive the drop off in supply is.
Yeah.
And so where in the great financial crisis or post GFC kind of had a longer tail of burning off those concessions. And concessions were in the market for a longer period of time. What I think you're getting at is, are we going to see these concessions come off relatively quickly? And it's anecdotally, again, the deal that we are looking at acquiring right now, we've noticed that because there were concessions in the market, because there's a decent amount of supply that was delivered a couple of years ago. It's all now been leased up. Our underwriting, we had underwritten concessions because the property was issuing concessions. The nearby properties were issuing concessions. Addison, who's been on the pod a number of times, went around all the competitive properties to do a survey. And very few, almost none, are offering concessions anymore. And so if that's the case, they feel like they've got the confidence and they have the demand to turn those concessions off. But if you're still in a situation of that's great, they've turned their concessions off, but I'm still 70% occupied, I'm not stabilized. You might really step on the gas to get people moved in. Because again, spending, $10,000 or so, but you're to save maybe hundreds of thousands of dollars in interest payments to shorten the window, because you can't even start the refinancing process, or you can't really bring it to market until that property is stabilized. And so getting to that, and that's typically considered 90% occupied.
So it does it's a purely from math. It's well, we could spend this much money because it helps save us on the interest rate. That's interesting.
We're gonna spend another $250,000 or $450,000 this year in interest carry. Or we can spend $50,000, accelerate, shorten the time frame to stabilization, and just it's literally just that time value of money.
Oh, wow. So you mentioned a little bit of absorption, and I've got a
new segment, Matt. We're trying something different here on the Gray Report. This is called Good Thing, Bad Thing.
I like it.
So often, even today, we're talking about some just positive signs in the market, and there are these stormy clouds over here. So good thing and a bad thing. So you're on the spot today, Matt, for the multifamily housing industry. I need a good thing and a bad thing. First, let's start with the good thing.
All right. I think, and it's something that you've probably heard before, I want to highlight regional performance. Regional performance really kind of just outside the Sun Belt. Across so many of the reports that I've been reading this week, they mention how, just one quote is from a recent CoStar report, the Sun Belt region has shouldered the brunt of the multi-decade high wave of apartment construction over the past few years, weighing on occupancy and rent growth. When thinking about national rent numbers, it's easy to see this stagnation. But I think what's something that's really interesting and really positive for places outside of the Sun Belt, for apartment operators, that is that in the Midwest and the Northeast and even really other regions, some, select in the West or on the coast especially, there is some improvement in apartment performance, a greater balance than the overbuilding that still is being worked through. And I think that overbuilding obscures a little bit and masks the performance that's happening in like Indianapolis, for instance, home of great capital. So that's the good thing. There's other good things, and you mentioned apartment absorption earlier. That was one I hadn't thought of just directly coming to mind. But yeah, regional performance is great. I will cheat and say an extra one here and say.
Oh man, no, hold on.
All right.
No,
right,
we're not. We're
we're one of those. It's like the code, like the.
Well, there has to be some standards at some point. There has to be some rules. Otherwise, it'll just be never-ending list. Okay,
unbiasedness.
Good thing is regional performance. We're really talking about the Midwest, the Northeast, really everywhere besides the Sun Belt. So really. Everywhere is doing pretty well besides the Sun Belt. Unfortunately, the Sun Belt is where a lot of people invested. Maybe that's the bad thing. But okay, bad thing, Matt. What's the bad thing?
I think it's interest rates. I think that there was really inflation numbers last week didn't really point to lower interest rates in the future, and we discussed that last week. I think that all this pressure on the Fed is also like, I'll just say it's like kind of like annoying from an outsider's perspective. It's like I just wish that of his own accord and the FOMC, the Fed and Jerome Powell can decide independently of all political influence to lower the interest rates. I wish that would happen, but now everything is kind of tainted with the idea of political influence. I don't like that. I think that the uncertainty over interest rates now, arguably, now this may be a hot take, is worse than the uncertainty over like tariffs and trade policy, because it just seems a little bit more impactful and has this direct impact on whatever the 10-year is going to be. I think I would include 10-year and Fed funds. And the 10-year has this interesting relationship with like general economic uncertainty and like faith in the U.S. And the Fed funds is more like, well, FOMC picks this number. I still think there's weirdness and it's frustrating thinking about both because I can't. And that's one of the reasons why it's a bad thing is it's so uncertain and it's, I don't like it. So that's my thing.
Matt doesn't like interest rates. I'll give just a silver lining, the other side of the coin to the interest rate story. Mm-hmm. If there's such an argument about rates needing to be higher, rates needing to be lower, the fact that there's an argument that rates need to be higher, sure, you could just say it's because of tariff, but it's because of tariffs. But really, it means that the economy is doing well enough.
Yeah, it's at a balance.
It's in a good enough place. The fact that we're even having the conversation of like, I don't know, the economy is too good. I don't know if we can lower rates. Mm-hmm. And just that we need to lower rates from like a structural standpoint, and it's the interest on the government debt, and to really stimulate the economy. And to me, that's a pretty good spot to be in. I think it can be hard to see the forest through the trees. And so I think, but I don't disagree that lower interest rates would be very nice. Mm-hmm. Certainly, the real estate world would rejoice with lower interest rates. The business world would rejoice. I think everyone besides maybe the banks, and the people who are really just want a recession to happen. So. Okay, so that was a good first
got one
segment.
Of each. I tried to cheat.
Good thing and bad thing. Love it. Okay. All right. I want to go to this piece on this topic, Matt, of trying to figure out are we in a good real estate market and a bad real estate market. And, I would even maybe say there's a theme here that if you really can't decide, maybe things like maybe this is just the optimist in me. Yeah. But if unless it's like really clear, I don't know, maybe it's a risk on. The net consensus should be kind of risk on. If we're like, well, there's so many good things, but there's a couple of these bad things. There's always going to be something that's scary. There's never been a time in real estate investing that it's been absolute clear. We're always there's always been a recession around the corner.
So I completely agree. I think that there is one of the articles here from John Burns Research and Consulting's calling for like a multifamily reset. I think that that's a more apt word, I guess, than a maybe recovery. Reset is like we got to reset our expectations, maybe sometimes reset our price expectations and maybe performance expectations, also interest rate expectations. And so everything has to be readjusted. I think and that involves some hard choices. And so it just doesn't involve prices going up automatically. It means some people are going to be losers and there's going to be some winners, some opportunities that come through work and not just like passively watching the property values rise like they did in 2021.
Well, we can let's go to the John Burns Research and Consulting piece in a second. I want to talk about the TREP piece first. But that piece is really interesting. Also, all right, so this piece from TREP, why commercial real estate's current stability may be masking mounting risks. Again, so this is the other side, glass half empty of, all right, things are looking all right. There's not absolute blood in the streets. Maybe we're getting to a point of clarity, a little bit of sunshine, but not so fast. Starts off in this piece, tariffs enter the macro frame. And there's issues with, again, cap rate spreads over 10-year treasury. Matt, what's bring us up to speed? What are we masking here?
Yeah, I think that this in general it's a broader macro level look at these economic risks and the implications of behavior shifts that may come from things like tariffs increasing prices and changing consumer and investors' uncertainty, and they're like staying out of the market because whether it's increasing prices or just their uncertainty, they can't predict what's going to happen. She did say though, and I think that this is interesting, and it speaks to the work that needs to be done and the difficult choices that need to be made in order for this reset to happen. She says cap rates are staying sticky, not because fundamentals have shifted, but because agreement on new valuation anchors hasn't formed. This is evident in the TREP property price index data as well, with the exception of lobbying. The TPPI data shows most property types are experiencing sticky prices. All of them seem like, the lack of change is a problem, and I think it's probably sellers not coming off their price or buyers not willing to bite on the higher price. It's a two-way negotiation, and I think that the small gap between cap rates. However, though, I think that the small gap between cap rates and interest rates suggests that sellers need to lower their prices, and because otherwise, then buyers are just buying additional risk, which
Why would a seller lower their price if the buyers are willing to take additional risk, though? I mean, I think that's I agree. Mm-hmm. And if you look at 10-year Treasury yields and interest rates, you can make an argument that cap rates should be higher than they are today. Mm-hmm. But the market is the market. I mean, we can sit here and have an academic discussion all day long, but when you look, the reality is, if two parties are getting together and they're making a transaction, deals are getting done. Mm-hmm. That's what the market is saying. Now you could say that there's not enough volume to really make a clear conclusion, which is what the author is saying, and I think there's definitely credence to that of hey, we have to keep watching this, but it's not like we're seeing transactions of where cap rates are blowing out. I mean, there's maybe a little bit of distinction between kind of the A class and C class asset class spread, which we've talked about in previous episodes. Mm-hmm. I think you are seeing some deals trade at it's 6% cap rates and slightly above. Mm-hmm. Some people think that deals should be trading for 7% cap rates. I don't think there's any of that going on unless it's like a really absolutely distressed deal, unique situation. All right, so I'm going to fast forward out of order, Matt. Sorry. Oh. But going to this piece from CBRE, multifamily, and the multifamily underwriting metrics improve in Q2, which is interest rate. They're talking about going in exit cap rates.
I do think this is interesting.
I thought so too, talking about unlevered yields, but I want to go down to where, oh my gosh, I'm trying to find
the chart of
chart. I know there's a sub 4 cap rate in here. Yeah, here we go. Sorry about that. The average core multifamily going in cap rate fell by 6 basis points to 4.75 in Q2, while the average exit cap rate fell by 4 basis points to 4.96. People are buying deals at sub 5% cap rates.
Well, and that's interesting too, because what this chart shows is since basically Q1 of 2024, going in and exit cap rates have consistently gone down. Now it's only just like slivers, but they have been going down. All but one of those quarters, all of those have come down.
And I think that's market sentiment and like the long-term fundamentals consolidating. But
it's a slow slog.
So we've got groups of investors who are saying no, 5% is a reasonable cap rate to pay for an A-class core multifamily deal.
Yeah, you're right. These are expectations.
But you have another component. You have another market segment that says no, 6.5%, 7%. Mm-hmm. And those deals don't really exist right now. Yeah. And so that's where you're getting this dissonance in the market and confusion of being like, well, the transactions are actually happening here, but you've got a group of people saying it's like, no, that's not right. Yeah. They should be taking it at much lower prices, much higher cap rates.
What is promising is, so, everything's around the edges, there has been a little bump in the IRR target. So that's pretty nice. After Q3 of 2024 and Q4 and then Q1, the IRR target has gone down for those previous 3 quarters, really 4 quarters, and now it's finally gone up. So that could be signs. I would like to see a little bit more momentum, though, to be sure.
Yeah, it's hard to get those IRR targets up if you can't really underwrite much rent growth, especially if you're talking about deals in the Sun Belt.
Yeah. Cumulatively, that looks like it's 20 basis points or more of IRR change between Q2 2024 and Q2 2025. So it's good to see a little bit of a short-term change.
And again, a lot of this is theoretical. I think, kind of in the model underwriting standards. But yeah. All right. You want to jump over to NMHC? We've got our quarterly survey of apartment conditions for July 2025. Again, this is put together by the fine folks at the National Multifamily Housing Council. Interesting results. Not absolutely shocked, but it's worth having a conversation. And no, I know, Matt, you had a couple questions about it, but you want to take us through some
I've got a few things.
updates?
Now, this does match well with the CBRE because it's kind of a sense of the market and not necessarily like a hard and fast objective measurement of what's happening in the market. However, they are giving this survey to a lot of smart multifamily professionals, so it's a great tool to figure out what is happening or what people kind of think are happening, in my opinion. So just going by the numbers here, and I have a brief interjection, and I'll announce it in a second. Though the market tightness is up from 52 to 54. That means respondents are seeing more competition among renters. So there are 4 categories here. It's market tightness, which is apartment fundamentals, basically. What are renters? Is there a lot of apartments? Is there a lot of renter demand? And that's measures with the higher the number as the tighter the market.
So tight is good.
Tight is good, and that's good vibes. Sales volume is apartment investors, buyers. So it's not the renters. It's how much sales activity there is, and how much with 100 being the most, and 0 as like a turgid dead market. Equity financing index is, can you get money from investors, right? How easy is that? And debt finance, how easy is it to get money from banks? Now, I don't know I think that this the debt financing does not reflect the high interest rates. It just reflects how strict banks are in giving you the loans. They'll give you the loan. It's just may not be the interest rate you like.
But this is also the opinion from borrowers.
Yes, exactly.
So
exactly.
there could be a little bit of like, they're not happy with the spreads.
Yeah.
Which is part of the term.
That's what I did want to highlight here. Now I've got another segment here. I'd like to call it, how does this make sense? So if there's a misconception worth pointing out, a surprising piece of information, or most likely something that just doesn't make sense to me, I'll put it in this segment. I'll do my best to understand, work things out, and who knows, maybe I'll figure it out. So here we go, and I think I do have a theory here. I've got at least a couple. How does this make sense? I'm looking at the market tightness numbers for now, and they really hit the floor. So right now they are at 54, but they really hit the floor around 2022 and the start of 2023. I think there's a graph here that shows market tightness. They really hit that floor in 2022 and 2023 in recent memories. I'm excluding the lockdown period of the pandemic. But if we're talking, in recent memory here in the past 4 years, that was the low
very
point.
tight. The highest level they've ever recorded, basically, during, in the peak kind of ZERP period, halfway through 2021, really kind of peaked right during 2021 and started cooling off by the second half of 2022.
Yeah. So and again, this is by this measurement, the lowest, the sense of market tightness was at its lowest in 2022 and 2020, at the end of 22 and the start of 23. But here's the thing: if you actually look at vacancy numbers from places like CoStar and Yardi Matrix and Apartment List, vacancy was about 1.4% lower then than it is now. So vacancy's higher now, and we're getting like 55 in vacancy, and then vacancy, or the market tightness, was 14%. So we are 55, and vacancy is.
So in January of 23, it was the market tightness was 14. So it is in October of 2022. It was 20. Now let's start at the beginning. Here, I mean, it was 96. This is when it peaked. Okay. July 2021.
That doesn't make sense to me.
96. And why is, so you're saying what doesn't make sense to you? Why in January of 2023?
Yeah.
I've got an answer for you.
All right. Well, I'd like to. Yeah. I'd like to hear your answer before I.
It's demand.
Yeah. Okay.
Demand bottomed out. I mean, if you think back to January 2023, that was peak interest rate uncertainty. That's when we were all like, nope, we're going into recession. The Federal Reserve is causing a recession right now.
Yep.
You know, it was less than a year since they started raising interest rates, and everything was slowing, was slowing down.
Yep.
So, I mean, I think that's where we saw renter sentiment, decline.
Yep.
As well as, buyer, owner, everyone had negative opinions about everything, assuming there was, this is like, the times when, recession call was like 100%, around this period. And it was also when we were building a lot of apartments, they weren't starting to deliver, but we knew that all these apartments were going to come online. We started, but we weren't seeing any absorption yet.
Yep.
And so the specter, the idea that we are going to enter a period of record deliveries with no demand looked like it could have been the death knell for multifamily. Yeah,
I think that was totally infecting. So their idea of their sense of market tightness, at such a low point was reflective of the absorption levels that were that low, and then they were looking forward. It had to be a little bit of a forward-looking sense because the absolute level of vacancy was lower than what it is now.
Which is, it's all interesting because you think that vacancy is a product of demand, but it's really not as much as one might think.
Yeah.
If demand was so low, vacancy was tighter.
You look at that one quarter where there was negative absorption, and that's basically the same. It's Q4 2022. That's the same quarter that they have the dip.
This is when the survey took place, I guess, the next month.
Yeah.
Right. Which makes sense. I mean, it makes sense. We just experienced this just coming off the tail end of negative absorption. It's really interesting.
I also
putting the data behind the sentiment also.
Yeah, exactly. When I saw that, I was like, oh, okay, that's I think that is the objective key, and it is one of those things that I've been thinking a lot about as I gather this report. It's like each week I'm trying to get away with things that aren't sounding the same, and the rent growth looks the same. Well, absorption is this. Is a clear positive trend where it has been stagnating elsewhere when it comes to rent growth, and vacancy has been rising, but there is a real positive story when it comes to absorption. Also, though, and I think that there's a survey. I think to go back to their figures here. Oh gosh, I'm getting it all wrong here. To go back to their figures for now, the graph they have. Sorry, for sales volume and market tightness. I think there is a telltale alignment of those lines that is not necessarily true to reality. I think that it was a bad time to buy an apartment around Q4 2022, and they were looking ahead at interest rate trajectory, and that also kind of maybe affect. Well, I can't buy one, but also I mean the market's so bad.
You need to own the property before the peak in demand happens.
Yeah.
You don't want to buy it after the peak of demand or like just at the peak of demand. I mean, that's what this graph shows.
Yeah, all the kind of ecstatic enthusiasm and the difference was so sharp then than it is now. Even though the snapshot moment. Interest rates are higher than they were then. Vacancy is higher than it was then. That snapshot, it doesn't really reflect sentiment because we've kind of adjusted. And that kind of brings me back to this whole point is people are learning to, for better or for worse, they're learning to operate apartments where the rent growth's not going to be low. They're learning whether, and it's going to be do or die for some people, but they're learning how to deal with all the massive expense growth. They're kind of getting a lot more resilient, and so they can build something that's better with uncertainty rather than like, well, all of their Excel spreadsheets are counting on that 5% rent growth, and that's not here anymore. Well, we kind of know what the bad thing's going to be, and we can project things a lot more accurately than, in late 2022, we thought, the good times were going to keep rolling.
If you haven't been adapting over the last couple of years, if you're an investor, an operator, whether you're on the asset management side, in now the property management side, or you're right in the property management world. I mean, if you're not finding improvements and getting by with less and finding ways to cut costs, but also delivering the value that residents or looking for. If you're not adapting, you're going to be losing.
Yeah.
And you're going to be losing in a sense of you can be growing your rents, but if you're not on top of your operating costs, like everyone's going to be up. Everyone, like so many groups, miss their budgets in terms of expenses over, at some point over the last couple of years.
Good point.
Because whether it's property taxes or if it was payroll or insurance, it those uncontrollable expenses, especially of like, what do you do when all of the insurance carriers are say, your insurance is going to go up by 2x.
Yeah.
Or you get a big reassessment on your property taxes. You can appeal it, but that takes time. If you're not able to be
Materials
nimble,
costs maybe.
Materials cost. Honestly, like sure, yes. Material costs are definitely expensive.
So like
too.
a construction that.
But that's where you have to find the opportunity to save money.
Yeah.
And not have the same operational playbook. And so if you haven't made quite a few changes over the last couple of years, you're going to be operating underwater a little bit. Or inefficiently.
And this is what I mean. This reset. This kind of like. There's a bunch of stuff that's so different than what it was like, and I think because the shift is so dramatic, you see that drop off in the sentiment from the NMHC numbers right here. But I think it's with that dramatic drop off, it's taken that long for people to really get a grip. But I do think though, out of all this, the absorption numbers are really what's helping people get some clarity and get some confidence more than anything else.
I think people are looking at the absorption numbers and saying, holy cow.
Yeah.
Again, the idea that we've delivered so many apartments, they're all getting leased up. Maybe not as soon as everybody, would like for them to be leased up, but there's clear demand. Again, we've gone back and forth on the whole idea that, single family homes are unaffordable. I think there's still, there's still a ton of demand for single family homes.
Yeah.
And we've talked about in the past that housing demand is housing demand. Single family home or apartment. It's going to be good for both, or it's going to be bad for both. I think right now it's good for both. I just think that there's tons of demand for single family home. People still want to form those households. It's just that that's just not an option. And so I do think people are going into rentals.
Yeah.
I just can't see any other way around it, or really any other explanation.
Yeah.
And I don't know. It's just a little too logical.
Yeah.
And maybe it's on the margins a little bit of those folks that were, I was absolutely going to buy a house. Now I'm going to rent an apartment. But I also think that's what's helping out the Class A a little bit. And going to that first story from RealPage about concessions.
Yeah.
I think that there's some people who are willing to, pay up for a nice apartment because they were like, well, I had saved up $50,000 to buy a house. Looks like I'm going to keep saving. Looks like I'm going to keep stocking it away.
Yeah.
But I want to make sure I get a nice place to live, especially if I've got a family or whatever.
Yeah. There is, and that's why interest rates are so frustrating. Is then on top of all that, there's this thought. Well, the demand is what it is right now. But man, once those rates come down, things are really going to take off. I think part of one of the adjustments that has been made in the past few years is this realization, if we need to survive for the time being, we have to factor these harsh realities of high interest rates. I think that there's some drama there though at the very end, especially for certain borrowers.
All right, last piece from John Burns Research and Consulting. Did you call it JBREC? JBREC? Did you make that up?
No. They've done that with themselves. I just sometimes I'll put that in the notes.
This piece from Chris Nebenzahl, friend of the podcast, as well as Wes Staten and Daniel Nguyen.
When?
No, it's Nguyen.
Okay.
It's like a Vietnamese. Anyway, Matt, apartment market's cools, but that's a good thing. And this was back to this conversation that you kind of kickstarted a couple minutes ago about this idea of the reset. And maybe we have a little bit of a difference of opinion on what that reset means. I'll let you go first.
So I think they spin it a little bit differently here, but I would argue that a reset's not a recovery. It's a restart, and it's not necessarily going to follow the same rules, the same course, and the same expectations as a current market. A recovery is just, all benefit, kind of a little less drawback.
Sorry, let me ask you this question.
Yeah.
Have we reset or are we resetting?
Well, so would be my next point is this is uneven, really, really uneven. I think that this recovery is a moment in the reset, but this readjustment, recalibration happens first. I think that recalibration has happened earlier for certain markets outside of the Sun Belt, but for the Sun Belt, no one's agreeing on something.
Let's exclude the Sun Belt for a minute, and for a second, and then we can bring the Sun Belt back in. So you almost do need to talk about the regions on their own, and then maybe we can make like an ensemble model. Combine kind of our thoughts about the different regions. I mean, it's like the Midwest. Is it resetting? Is it recovering? Is it in recovery?
Well, no, I think
it reset?
I think that the Midwest is in recovery. I think the Midwest's resetting happened, in the past few years when we did see tangible value declines, and it wasn't as sharp because there wasn't so much overbuilding. I think that if you do look at nationally, there's a lot of opportunities because some places are being negotiated. You can catch places at different moments in broad regions, really, in different moments. And maybe there is a argument to be had to come in and swoop in the Sun Belt at some point. But I think that there wasn't the fervor in the Midwest and the Northeast like there was in the Sun Belt.
In terms of building.
Yeah, in terms of building. And so, the negotiation, the resetting and the readjustment phase is going to be choppier because they're overbuilding, but also because maybe the investor attention it kind of obscures it a little. I don't know.
So what you're saying is in like the Midwest and the Northeast, really less of like a full reset, but more of like kind of slowing down, like recalibrating, kind of like needed to catch its breath a little bit.
Yeah, well, if you want to say
rather than like in the Sun Belt, like in Austin, it's like, okay, we got to patience, got to
stronger reset, a stronger readjustment in the Sun Belt,
and then we got to bring them back.
Yeah. Whatever process they are describing here, whatever I'm insinuating here in terms of resets, happening more strongly in the Sun Belt, and it's at an earlier stage than the Midwest. But like what I was kind of harping on this whole episode is like, this does mean there is some pain and there's some work to do because it's not all going to be easy. And part of that reset, part of that readjustment is adjusting those hard things, that we just kind of discussed. And that means like saying we've said no to a lot of deals, and it's almost reassuring that it's not that easy because we've been through this. We've been through this for 2 years, and we can kind of see things with a little more clarity. But yeah, I would like things to move at a different. I'm sorry, I'm kind of shifting here, but I want to turn back to my notes. It's the idea that that the Sun Belt is moving national rents down is something that I put earlier in my notes. And I do think that that there are general trends that run through everything. And we have looked at rent growth stagnation. There has been relative stagnation in the Midwest, relative stagnation in that same process is just happening harder in the Sun Belt than it is. See, now I'm back on track. Okay, these things are so dramatic in the Sun Belt, and things are just at a different stage, and they're happening more weekly in the Midwest and the Northeast.
Yeah, I think the Midwest is restarting, and it's just not a like pedal to the metal. We're going to restart with really, really strong rent growth because it's still also in the Northeast, still getting through record supply relative. It's just not as extreme as in the Sun Belt.
Yeah.
I want to mention on the article, this piece from John Burns Research and Consulting. I think this is a good little blurb breakout. Don't be fooled by today's rent growth struggles. Saying this is what we were saying earlier. There's no choice but to rent, with homeownership historically out of reach for many households. Renting is the only option. Following new supply, apartment completions are plunging, and occupancy will return to normal soon. Then go north and west. While the Sun Belt digests a flood of new supply, the Northeast, Midwest, and parts of the West Coast are already thriving. It's basically what we have been saying.
Yeah, I mean, you can gerrymander a Sun Belt that has a lot more success, but I think that in general, like that's where we're seeing the struggles, and it's very interesting how much. I mean, they must be really building a whole lot because if 3 out of the 4 regions are doing okay, but then there's just one laggard. That's the size of that supply wave over there.
I thought this piece was interesting. Also, smart capital is moving in. It says transactions are light, stalled by rate uncertainty and valuation gaps, but opportunity is out there. Institutions with long-term view are selective. They're favoring great locations. Private capital is active, chasing distress in all-cash deals. But to be clear, deliveries are slowing and starts are trending near levels seen in the early 2010s. So it's saying here, kind of ending the piece, the next cycle is quiet for now.
Yeah.
And that, to me, that sounds like a time to get in when things are quiet. People haven't started making the moves yet.
Yeah.
But admits, I'd say a significant amount of noise, and I'd even say some of the pieces. There's like piece from Trep earlier. If I can find it, a lot of this is noise.
Yeah.
Just like this is just some of our thoughts generally on the market, and it's here's a lot of numbers and statistics, and here's a bad way to look at the market. Tariffs I think are. There's no better example of noise than tariffs.
Yeah.
And uncertainty and tracking uncertainty, trying to quantify uncertainty. So much of it it's got to pay attention to it all, but it's relative noise.
Yeah.
And again, you can't ignore it. But when you're making a decision for an investment that's going to last over a long period of time, more than a couple of years, consumer sentiment. 5 years after you've done the deal, it's more of, what's the condition of the deal, market conditions when you fully season the asset and you're looking to capitalize and sell it in 3 to 5 years. And it would be somewhat textbook to buy something at lower consumer confidence when there's market uncertainty and then dispose of it when tides have shifted and consumer confidence is high and prices are high. I mean, that's again, that's business 101. Buy low, buy low, sell high.
And that's probably informing a lot of the sentiment among in the NMHC as well. Is they recognize it's around the 50% mark for their sentiment on the market. But I think they do recognize like this is a moment where we can see clearly that supply's falling off. We have those absorption numbers again that have just been going up every consecutive quarter for the past year or so. There's a really good. I think there's a strong confidence that you can have even though things were so uncertain. And like I mentioned before, we've been through this, so we know how to survive now. And I think that's a really big part of it.
I think this is an appropriate time to mention that with all this being said, I mean, we have been looking for a deal at Gray Capital all year. We finally found one that makes sense. It's going to be the only deal we do this year. Only one. People ask, how many deals do you guys do? We love to do 4 or 5 deals a year, but we have to find 4 or 5 deals a year that make sense.
Yeah.
We can raise the capital for 4 or 5 deals. It's not that we don't have the money to go do 4 or 5 deals. We have to find 4 or 5 deals that make sense.
Yeah.
In this market, we can't overpay. It's got to be a good location. It also has to be a deal where there's like investor interest. I could find a deal that I'm highly confident this is going to be a successful project. Yeah. But I also have to convince LPs, equity, to come on board with us. And sometimes, there's a deal where it's like, what? My gut says this is going to be an excellent deal, but I can't underwrite it where it makes sense.
Yeah.
It's a no-go. The heart, the science, the brain and the heart have to kind of all both be in alignment. You have to be able to justify it on paper also. And so we have to find a deal that checks all of those boxes. It not just feels right, but logically all the metrics check all the right boxes and there's actual interest in the market. Yeah. We found that deal. It's incredible. It's in Indianapolis. It's in our backyard. Yeah. 292 units. It's suburban. It's this textbook example of, The submarket experienced more supply than it's ever experienced before. Not a ton compared to like nationally or really even compared to the Midwest, but just more apartments. It was like delivering a couple hundred units every year or two. Then all of a sudden, like 1,000 units just get dropped in the market. Now they were all absorbed. It's the same story. Absorption just peaked. Like the markets have been absorbing like 200 to 250 units a quarter.
They look pretty confident if Addison didn't find any concessions either.
Exactly. Well, so that's the thing. There were concessions in the market.
Okay.
But now they're dialing down. They're going away.
Yeah.
And because all these deals are getting leased up and they're growing rents by 4 or 5% on their trade outs. The demographics are exactly what you want to see. There's been 20% population growth since 2010. Average household incomes are like $114K. Median like per capita income is like $94,000. So solid incomes, great jobs, all the retail, which is going to create other ancillary jobs, medical facilities, but all this retail is popping up. A grocery store is coming up. It's all the things you'd want to see. Lower taxes. Indiana just passed a new tax bill that's going to have the property tax assessed value of this property decreased by 35% over the next 6 years.
Wow.
And no one knew about this when we bid on it.
Yeah.
So we were only the few that were actually able to incorporate this into the underwriting, had our tax attorneys look over it. Exciting deal. We can only go forward with this if we have confidence in it.
Yeah.
And we're raising about $25 million from limited partners. The GP, Great Capital, we're putting in $3 million, over 10% of the co-invest. It's a lot of alignment. And that doesn't include any of the fees. That's just money we're putting into the deal. That's just not we're getting fees and we're not actually putting any real money. It's actual cash that goes into the deal. We're really excited. That's what we're going to be working on the rest of the year. It's going to be the only deal we do. Yeah. So some people say, well, I want to hold off. Maybe you'll get a deal near the end of the year.
Maybe.
This is it. This is it.
Yeah.
We don't have any. So we've seen some other similar good guys, other competitors out there, syndicators. They charge so many fees, man.
Yeah.
Disposition fees, refinance fees, acquisition fees that are well over 2%.
Yeah.
The splits that are very favorable to the GP. We're at a position of like, we want to make good money, but we don't need to make all the money on every deal.
Yeah.
I'd rather have our LPs have a very successful outcome so we can do more deals down the road.
Yeah.
So like we've got like an 80-20 split where like everyone else is like 70-30 and then like there's a 50-50 split at some point. We have one tier, it's 80-20 throughout the whole thing. So this thing goes asymmetric. Blackstone decides they want to come into Indianapolis, which is a definite possibility. This is the type of asset they would want to acquire. So they come in, want to pay a sub 5 cap rate, mid 4s, which we're not underwriting at all. We're underwriting, high 5, mid 5s, high 5s. All of a sudden, interest rates come down, cap rates come down. We have a true asymmetric risk profile, which like base case, it's stabilized, steady asset. We've got a tactical value add plan to accelerate revenue through short-term rental strategy, AI dynamic leasing model. We have a centralized management pod in Indianapolis. So we have multiple properties in Indy that we share resources with our corporate team. We've got all the right things going for it.
It's a really nice building in a really nice place.
High quality, A-class. We know the developer personally. It checks every box. That's why we have the confidence to put more money into it than we've ever done in a single deal. It's why when we've started our fundraise from existing investors early, we've never had this much interest.
Yeah.
Never.
Make it easy for Blake and Griffin. That's so nice.
My concern now is we're having conversations with some institutional groups. They want the whole thing. We have to decide if we're going to do that or not.
Man, that's a lot less marketing. I think you'll need a couple phone calls and this is done. This is not how it usually works. Oh man.
And it's tough because we've got individual investors that we need to get into the deal.
Yeah.
So if we can get enough of the deal raised in a short period of time, we're not going to go the institutional route.
Yeah.
We're just going to do with family offices, high net worth individuals. I mean, institutions can come in; they just can come under LP terms. We can't give them half the deal in some special terms. We're not giving any special terms to anybody right now because the deal is filling up. We're getting multi-million-dollar commitments with no special terms. So But man, if you've been looking for a deal, that again, it's like I'm not going to use the term safe, but a solid deal with strong returns, base case, conservative, but an opportunity for upside that you're not going to get capped. Because a lot of these deals, like they'll do really well, but then the GP, like you'll get over a threshold of a return, and the GP makes all the money.
Okay.
And so it's like the deal can only be so good. It's like you hit a 15 IRR, and then the GP gets all the rest of the money.
Okay.
And so like the LP's like, great, 15 is good. It's average actually.
Yeah.
But like you're taking this incredible deal and turning it into an average deal.
Yeah.
I mean, good for you, the GP. I mean, that's like in the GPs, you're either going back to the cigar lounge and being look how much money the GP made. That's like that again. That's awesome. Everybody's in it to make money. I want to make money too, but I want to do like really good deals. And I could
have fudged the numbers a little bit more and get a little more fees, a little more little less friendly split.
We could have cranked it. We could have cranked the fees. Yeah. We could have cranked the fees up a little bit more on this deal. But we want to deliver something really good for our partners and investors because we can do anything without partners and investors. So we're going to do one deal this year. Be a good one, good deal for everybody. It's a big deal. It's an exciting deal.
Yeah. We're all excited.
GrayCapitalLLC.com. You can learn more about it. There's a button.
Awesome.
Or there'll be a button.
Yeah.
Very soon.
I will put the link in there when I am legally able to.
All right, go check the new deal out. It's only open to accredited investors. That's because the SEC doesn't want you to spend your money how you want to, but that's a conversation for a different day.
Maybe it'll be different too by the time we get.
Maybe, who knows? You can go and take that test.
Yeah.
Well, anyway, this is a great episode of The Gray Report. Don't forget to subscribe. If you're here at this point, hit the bell icon. Make sure you're alerted about all the episodes of The Gray Report. We're also going to be dropping videos for our upcoming acquisitions. If you want to learn more about that, another good reason to subscribe. Leave a comment. Tell us if you like some of these new segments that we've put in. Just mixing it up a little bit. I thought it was great. I thought that was really good. I thought it was really good. I liked it a lot. I think we're going to keep doing it.
All right.
Let us know what you think. And if there's something you want us to cover, like there's a topic, piece of data, research, an article, drop it below, send it over to us, and it's going to get moved right onto the docket. All right, everybody, stay safe out there. Make some good investing decisions. We'll catch you in the next episode of The Gray Report.